Okay, let's talk about oil marketing companies. They are in focus on the back of multiple brokerage notes. Sonal joins in with more. Sonal.
Bullish notes coming in from brokerages on oil marketing companies. Let me start with Morgan Stanley. They have an overweight rating on the stocks. All three of them have increased the target price on all three names substantially from the current levels. That number will come up for you on the screen. Now, why are they so bullish on these names? They say fuel retailers' free cash flow will be as large as third of their market cap over the 3 years cumulatively after the $20 billion of investments come on stream by FY27. Half of this free cash flow that will be distributed, and the 20% return on equity and 10% dollar earnings CAGR of over the 3 years will make these stocks very attractive for shareholders. They prefer HPCL over IOCL and BPCL as well. $65 to $70 per barrel. The crude levels is a sweet spot for OMCs, but we've seen in the past that crude price movement hasn't impacted them so much on a daily basis. Reduced intake of Russian crude has limited earnings impact for Indian refiners. They do not think it will be a big impact, and they will continue their growth CAGR going forward as well. Even Goldman Sachs has increased OMC's EBITDA by 3 to 9% for the next two fiscal and 12 months target prices by 9% on an average. They estimate there's still a 5 rupee buffer in the marketing segment to cut prices before the margins can drop to normalized levels. They have high levels of spreads around 11 to 12 rupees on gasoline and diesel. They reiterate their buy rating on HPCL and BPCL, where they think the current valuation have good risk reward for stakeholders, and LPG losses have narrowed over the past few years, so that will also bode well for their marketing segment. That's why Goldman Sachs is also very bullish on these names.
Thank you, Sonal, for explaining that so well. Dharmesh Kant, head of research at